Alright, so a few things I was wanting to share, just real quick. Today is another good example of, well, two things. Number one, trending trading range days. And that is simply, we've had a couple today. It's where you go sideways, you have a breakout, and sideways.
A little too short.
So yeah, as I said, right here is the same thing. Sideways for about 12 bars or so. Breakout above here, and eventually we closed the gap. Arguably we closed it here. And we broke out above here, and it took, the rest of the day nearly to close the gap. So, a few things with this. First off, I already mentioned earlier in a prior video today about the moving average and how we had a breakout pull. It's a breakout pullback buy setup. When we broke above here, you have to notice that we went sideways for more than 20 bars. Just look at it. Look at it like this. Spike, pullback, channel. And ever since, arguably we were clearly going sideways from 1150 onward. The bulls, they want a measured move up from this low to this high, and this to be a measuring gap and project up here. The longer it goes sideways, however, well, the closer, arguably it's 50, arguably 20 bars sideways makes the probability 50-50. That's just kind of one of those in general things. So if a swing trader's holding, betting on the measured move, at some point, the longer this goes on, this trading range right here, the longer that goes on, the more likely they're going to give up. And notice this. Take the opposite side of that trade.
Good bar for the Bears.
Yeah, so, think of it this way. A lot of traders will sell here, or they'll sell, halfway up to this measure move, and arguably they'll put a stop here. They'll sell somewhere, in other words, they'll sell here, scaling higher, have a stop up here, betting price will close this gap. So let's say you have this high, 45.25, and this high is 49 even. So basically you sell here, sell 4 points higher, or you simply sell 4 points higher, and then you make 4 points. So yeah, that's really the main thing. My whole point behind this video is when you start to go sideways for so many bars, the odds will favor a trading range, like right here. Bear breakout, trying to break some new low, trying to test the open of the day. The bears need one more bar. And guess what? Maybe 50-50, but I'm convinced that they're probably not going to get one more bar. And I think a lot of bulls will buy here. They'll buy this close and they'll bet that the bears will fail to get to one more bar. And if they do get an equal bar, closing when it's low, we'll probably get sell to close. If you're in Al's chat room, he just said that. Biggest point, when you get a spike that starts to go sideways for more than 20 bars, the odds favor a trading range. Trading ranges disappoint. So, really at the end of the day, we probably won't make a new high, but it's high probability that this gap will close. When you go sideways for, when you get a big up, big down, big up, it's basically sideways for that many bars. When you break above it and start to go sideways, the odds become really high, maybe 60%, that this gap closes. So that's what creates a trending trading range gap. Here, let me find, this is kind of an example here. Sideways for, let's just say 12 bars, bear breakout, close the gap one in the middle. So here's an example where we did not close the gap and we just rallied up into the end. So we'll find just a quick easy example. Yeah, here's kind of one. Sideways for at least 12 bars, broke out to the upside, closed the gap. So yeah, hope this video helps. Let me know if you have any questions.